If you follow this path, this will be the key to your riches. The truth is that if you divide the amount of money and credit that's used for spending by the quantity of goods produced, you can calculate, well, the prices will change. Three things that are happening in our lifetimes that never happened in my lifetime or our lifetimes, and that I learned before I have to study past periods. And those three things, as you point out, are the creation of a lot of debt and money. The second is the amount of internal conflict that we're having over money and values and what that's like. And the third is the changing world order with countries like China and Russia competing with the United States in a way that didn't exist before. So back to the point that you're making about that money, it's a basic thing. Everybody agrees we need more money and we need more spending. But if you spend more than you earn, you have to borrow. And that creates debt. But that at first it's credit, so it gives you buying power.
Right.
But you have to pay it back, and that becomes depressing. And so in order to avoid that, central banks can print money and buy it back, right? But when they do that, that depreciates the value of money. So what we had was a lot of money and credit go out to a lot of people, a lot of buying power. Everybody, when they got it, they thought, oh, that's great. And somehow they seem surprised that when they spend it, the prices of everything go up. The truth is that if you divide the amount of money and credit that's used for spending by the quantity of goods produced, you can calculate, well, the prices will change. And so that's what's going on. And that's what went on in a giant wave, the Federal Reserve and the government together, a giant wave. And that produced a giant amount of inflation, It's between 7.5% if you use year over year, or if you take the core inflation rate, it's closer to 12. And it's rising. There's some temporary influence, but it's basically because of the amount of spending. You can measure the amount of spending, not because of the bottlenecks. Buying power is what matters, right? And so what happens is when inflation goes up faster than your other sources of income, you lose buying power.
Okay.
But what happens is somehow that seems more acceptable sometimes to people than if it was just taken out of your pocket. You see, if they, let's say, raise taxes or take it out of somebody's pocket, everybody complains, whoever's had the pocket taken out of. But if it comes through printing of money and everybody gets checks, it's more acceptable. But what happens is those who are holding money, like money market funds and bond funds, lose the buying power of that. So think about those bond funds. Those bond funds are like down about 10%, and inflation is up over, let's call it 8%. So they lost 18% of the buying power.
Wow.
So it relieves debt. And so we're seeing a time now where you're going to lose buying power to inflation. And now you're going to see the Federal Reserve also tighten money and credit and raise interest rates. And when they do that, that creates less buying power, because when they say, okay, now you can't spend as much money and the prices are going high, but they do that in their crude way of trying to reduce inflation. But you get it from both ends, the higher prices and then the higher interest rates you have to pay. And also, and the higher debt service costs, and also less availability of money. So it's a squeeze, like the squeeze that happened in the 1970s. Everybody's mindset is in a paradigm shift. Everybody's mindset is in a certain place, and they're doing certain things. For example, investors think that cash is safe, and they don't pay much attention to inflation. And then what happens is they get inflation, and they realize that if I'm holding cash, I'm losing buying power. So then they shift. They sell out their cash, or they sell out their bonds, and they put that into other things. And when they do that, that also contributes to inflation. Changes like that also happen in a lot of ways, like cost of living increases in compensation. Where in the past, when they don't worry about inflation, then they don't think about, do I have an inflation-linked contract for my work? Right. Or do I have enough inflation assets? It might be, do I need to buy, I'm going to store my money in a house, or I might store my things. And so that pendulum swing from one mindset and one positioning to another mindset and another positioning in the early stages tends to be self-reinforcing. Those actions produce more inflation and more inflation psychology until that goes to the opposite extreme. If you find individual bets that are diversifying, that your return will equal the average of those returns, but your risk can be cut by 80%. And by a bet, I mean, like if you say, I'm going to invest in the stock market.
Yes.
You can see whatever the bet is, you can see, look back in history, it gives you a pretty good idea of how it goes up and down, what your risks are. Do that by looking at it in inflation adjusted terms is the best way, but it goes up and down, and you can see how your buying power is. And if you say, if the worst case happened, what would that look like? And I'm telling you, like I'm saying, that could be that the worst case is, when you look at that, is something like 60 or 70% in buying power, whether that's stocks or bonds. Okay, that's what the risk looks like. However, if you do that with uncorrelated investments, when one goes up, like when commodities go up, bonds go down, or that kind of thing, and you balance things, then you find some part goes up and another part when the other part goes down. And by doing that, you can reduce the risk without reducing the return. If you follow this path, this will be the key to your riches. And what that is 10 to 15 good uncorrelated return streams.